I would like to welcome everyone today to today's Learn at Lunch webinar. We will hear from Dr. Derrell Peel, the Extension Livestock Marketing Specialist here at OSU, about the prospects for grazing cattle on wheat pasture this year. If you have any questions for Dr. Peel, you may ask them through the chat window by clicking the chat button at the bottom of the screen. Dr. Peel will answer questions at the end of his presentation. Additional farm management resources may be found on the eFarm Management page, and I will share this link in the chat box. Dr. Peel, I will turn it over to you now.
All righty. Well, thank you very much, Brent. I appreciate that. And thanks everyone for joining in this afternoon. So let me start my screen share here, and we will jump right into this in a fairly short amount of time, try to talk a little bit about sort of what we're looking at for fall grazing prospects and stocker prospects in general. And this would also apply to, cow-calf producers in terms of retaining wean calves through a backgrounding program. It's really the same business. So to do that, I'm going to quickly review just kind of where we are in the markets. There's a lot of market fundamentals behind all of this, and we don't have time for me to really go through all of that. But just to kind of review where we are, you can see from this graph, calf prices in the Southern Plains, we're substantially higher than we were this time last year in general for these calf prices. And we're going to talk about seasonality and kind of what we expect for fall prices here from a stocker perspective in terms of what we're going to have to pay for these stocker calves. From a cow-calf perspective, more in terms of what we're expecting for market prices. But the bottom line is that all of these markets reflect, an improvement, certainly on a year-over-year basis, as well as, more recently, and quite a bit of optimism going forward. The bigger feeder cattle, even more impressive. If you look at the run again, we're well above where we were this time last year, the dotted line being 2020. At this point, we can kind of make year-over-year comparisons. First half of the year was really hard because we had the initial pandemic disruptions last year. Some of that is beginning to not be so much of an issue. So we can kind of go back to comparing on a year-over-year basis. But again, you can see a pretty impressive run here on these calf prices. Not going to spend much time talking about this, but obviously feeder cattle markets are going to reflect the fed cattle markets. And this has really been the bottleneck all year. It's been a slow grind. We're way ahead of where we were this time last year. And this market last year was still struggling with those pandemic disruptions. And we still are, frankly, in a different sense. And so it's been a real slow grind. But there is a lot of expectation that this market will actually improve here as we finish out the third quarter into the fourth quarter and so on. And I've got some longer price forecasts here at the end of things. Just to sum it up or wrap it up here, box beef prices, again, from the demand side down is very strong. We had, kind of an early summer run up in box beef prices that were stronger than expected, I think, generally. And then we had a late summer run up here ahead of Labor Day that was even more impressive in some sense. And so all of that's a backdrop, again, to what's keeping what's building some of the optimism in these cattle markets. So that leads me to then the things that work into specifically for our stocker prospects. And to get into that, you really have to look at these grain markets. And so you can see where we are. Corn prices obviously are way above where they were. This time last year, they were just beginning to sort of take off. If you look at the dotted line from 2020, we started to see grain prices move up in the fourth quarter of last year, and then come into the year substantially higher in 2021. And then, of course, a massive run up here going into the summer. And of course, we're still finishing out this current crop year. Actually, it ended the end of August, and we're just starting a new crop year. And I'll show you those numbers in just a minute. But the bottom line is we're in a very different place in terms of feed costs. That affects feedlots. And let me finish up on this, and then we'll talk about the feedlot situation. So, this market is very much demand driven. I won't spend much time on these market fundamentals, but what you see is for 2020 was a huge increase in corn exports. and expected to continue fairly strong. And so it's this demand-driven thing that's driving this. Corn production is not a problem, and this is not this, current corn price is not something we're going to fix with this harvest that we're getting into right now. 2021, we're going to have a roughly 15 billion bushel corn crop. That's a big crop. It's not a record crop, but it's a big crop. And despite that, we expect these prices to continue. So on we've got low ending stocks because of the demand and the additional shipments that we've had, particularly to exports. That's what's keeping prices high, and that will continue to keep prices high. We might rebuild the ending stock somewhat over the next year, but at that level, we will still continue to see fairly strong corn prices. So, we've got corn prices for 2021 and 2022 staying up here in a range we've not seen in a number of years. And so that's the backdrop. Again, that's not something that's going to go away fast, and that really affects expectations as we go forward. So here's the outcome of all of that. This is the Kansas feedlot data that we get every month. And so this plots feed cost. I just did the steers here. There's a similar graph for heifers, which has an even higher each month reflect more months of the higher grain prices. And so it hasn't topped out yet. It probably will top out here fairly soon, but we're up there with a cost of gain now that's over $1. In fact, I'm going to suggest that we're pricing it more like $1.10 to $1.15 at this point in time. So, feedlots, again, if you think about how feedlots operate, just because feed costs are higher doesn't mean we're not going to feed cattle. We're going to continue to feed cattle. The cattle are out there. High feed prices doesn't change the overall supply and demand balance for cattle numbers, but it does change how feedlots make decisions about what kind of cattle they want to feed and how they want to feed them. And so that's what really begins to get back to our stocker prospects. So I can illustrate that most clearly here with two plots. And I picked the most recent week is the blue line. This is the average auction price for steers in Oklahoma this last week. And I put the prices on here so you can see where we are right now. We've got these, 475 pound steers at about $1.75 out here. And if you compare this to back in April, I just picked this to kind of illustrate how the market's changed over the summer as we have reflected those higher feed prices. Largely, that's what's driving this. And what you see is that the calf prices are not vastly different from where they were in this context, but the heavyweight feeder cattle prices are significantly higher than they were back in April. Now some of this reflects the seasonality that normally is there, but it also reflects one of the biggest things that feedlots do in response to high feed prices, and that is that they try to buy bigger cattle coming into the feedlot and cut down on days on feed a little bit, or at least that total feed bill. And so that increases demand for the big feeder cattle relative to the lighter weight feeder cattle. Now the calf market is kind of apart from all of that. Once you get down below 550 or so, the calf market is a different world. Those are really, those are sort of the next crop of feeder cattle. But from, feedlots have a choice. They can buy a 600 pound steer, or they can buy an 800 pound steer and think about feeding them. And the implication of high grain prices here is that they would prefer to feed an 800 pound steer and let somebody else put those 200 pounds of gain on that 6 weight feeder animal. And that's obviously then the job of the stocker industry when we get into that situation. This is an average over the last 4 weeks. So it's the same plot, except I just used 4 weeks. It smooths it out a little bit. Sometimes the weekly data kind of jumps around. So the blue line is an average over the last 4 weeks of steer prices. The red line reflects how a feedlot would evaluate that 575 all the way up to an 825-pound steer. So the idea here is if a feedlot looks at the price of an 825-pound steer, and they can pay that for, the price is what it is. So that price is coming from the marketplace. But then they say, well, I could buy a lighter weight animal. How would I do that? If I use a 115 cost of gain, and figure what it's going to cost me to put those 250 pounds on that animal or anywhere in between. This red line here plots that feedlot trade-off, if you will, for lighter weight animals compared to that 800-pound animal. And these calculations in this case are based on the idea of a $1.15 cost of gain, which, as you can see, sort of lays right on top of that market line. In other words, the feeder prices that we see today is reflecting a feedlot cost of gain of about $1.15. And you can see, for example, if you took that same 825-pound price and made the same calculations, a year ago when corn was a lot cheaper at let's say an 80-cent cost of gain, that trade-off would be up here someplace. In other words, feedlots in that case would be willing to pay a lot more for those lighter weight animals when it didn't cost as much to put that weight on. So that's how the feedlot looks at this thing. And what that does is translates very directly into then what the market is offering to stocker producers to put that weight on. And that's how the market coordinates this. It's different people doing different things. It's not like the feedlot people call the stocker people directly and say, I need you to put more weight on. But the market reflects what the feedlot decisions are. And that then becomes what the stocker producer sees as opportunities that we would think of in terms of the value of gain. So if you calculate from those August average prices, so we've got a range from 400 to 900 pounds. We put in the average prices from that auction data. There's the value per head. And then we calculate the value of gain for putting weight on. So we can start, wherever you want, 450 or a 500-pound animal. If we use this 500-pound animal at the price it is at this level, at this point in time, and we start putting weight on it, what are the value of those pounds? So the yellow boxes for each weight here, beginning weight, reflects 250 pounds of gain as a kind of a typical stocker situation. So from a 500-pound to a 750-pound animal, the value, we're going to sell that in this market. This is all on today's prices. We're going to sell that 750-pound animal for $1.57. But the value of those pounds is less than that. It normally is because, we paid $1.74 almost for the first 500 pounds, and we're going to sell those pounds cheaper. And so when you figure all that into the overall increase in value of the animal, the value of gain comes out here to $1.23 at this point in time. And you can see from 450, all the way up to a 600-pound animal that we could start with potentially, the value of gain is pretty close to $1.20 a pound. Those lightweight prices were sharply higher. There's a little bend in this thing. So if you started with a really lightweight animal, the value of gain is not very good initially because the price is falling very fast. But even that, if you started with a 400-pounder, by the time you put 250 pounds of gain on it, you're getting back up there pretty close to that same value of gain. So, so the point is the market's reflecting, and this is really the sort of the mirror image of what the markets or what the feedlot cost of gain is. This value of gain goes up as the feedlot cost of gain goes up. And it's a question of who's going to put that weight on those animals. And so, again, if the feedlots would prefer to have somebody else do it, then the market prices start reflecting that opportunity for stocker producers. So, and we've been seeing this for several weeks. I've been calculating these almost on a weekly basis for several weeks. As this thing developed, and these prices have evolved through the late summer and into the fall, we typically see that. Now, if you're a stocker producer, you're going to try to plant wheat. There's a whole host of production questions that I won't talk about, but if you can get past the armyworms and other things and actually get some wheat planted here and get it coming up so that you're going to be ready, hopefully 1st of November or maybe middle of November, to be potentially ready to graze some wheat. So, we're going to be buying stocker cattle sometime between now and then. And one question is, what am I going to have to pay for them? And then obviously, what am I looking at on the other end of the budget? Now, these value of gain numbers that I just showed you are all based on today's market. So, we're probably not going to buy fall stockers quite yet. So both the buy and the sell price are not where we necessarily are, but it's a good way to look at what the market, the way the market is set up right now. From where we are today, so if you take those August prices for the lightweight calves, 4 to 5 weights, typically from now to October, we would see about a 4.5% decline seasonally. This is a 5-year average seasonal price index, and we would expect to see that as we get our normal fall run. The 4-weight, that 475 pound steer was about $1.75 right now. That would suggest, based on the seasonality, that we would be looking at a October price that would be somewhere below $1.70, $1.67 or $1.68. I don't think that's going to happen. We'll get into that in a minute, but that would be the normal seasonal pattern. And I do use these. I think these are very strong, but there are times when you recognize that we're probably not going to follow these seasonal patterns. Now, this graph is pretty messy because if you put the heavyweights on here, you see that you have a very different seasonal pattern for them. The calves are high in the spring and low in the fall. So the first half of the year is higher compared to the second half of the year. For the big feeder cattle, it's exactly the opposite. They're gonna be lower in the first quarter of the year and start working their way higher and end the year somewhat higher, although they will fall off a little bit typically in December. And so, again, what we've seen on these big feeder cattle kind of reflects that. I did want to mention very quickly, one of the things that typically happens, this is from last year, but this happens nearly every year. From early September, so about where we are right now, this was the price line a year ago, the blue line. But by 5-6 weeks from now, we start to see this thing has a kind of a low spot here around 6 weights. Okay, so typically the calf prices, they may go up or down, but in this case they weren't vastly different. And the big feeder cattle weren't hugely different, but there was a big gap here, really kind of a sag in that price line for the 6-weight cattle. And that happens nearly every year, at least in the Southern Plains. And it sort of reflects the fact that even in a year when feed costs are not an issue, relatively speaking. So last year, feedlots would not have been thinking about higher feed costs affecting their decisions. But at that time of the year, as we get into October, feedlots look at, do I want to buy a 6-weight steer or an 8-weight steer? And it comes down to what market am I feeding against? And so early this morning, I shot a picture literally of the feeder cattle or the live cattle board. And the reason that 6-weight gap appears, that low demand for 6-weight animals in October, comes down to the fact that feedlot can feed a big steer, an 800-pound animal, against the April market, which this morning was about 138.70. It's dropped some during the day here, compared to that 6-weight steer is going to feed against the June market, which typically is going to be anywhere from $5 to $10 back of the April. That's the normal seasonality that's in that live cattle futures market. And so the feedlot, if they have a choice between a 6-weight steer and an 8-weight steer in October, generally they'll pick the 8-weight steer relative to the 6-weight steer, just because of that normal difference in spring futures. That could be exaggerated even more given everything we just said about the impact of high feed prices. That's going to probably exaggerate that anymore. So we'll probably see that develop here over the next couple of weeks. So, again, what are we going to pay for those animals? Well, the October feeder cattle futures this morning was about 162. Again, I think they're off a little bit during the day, and they do go up and down a lot. October at 162, that's actually higher here than where we are currently for the September board. So that says, feeder cattle in general are going up compared to down. Now the contract is based on 8-weight steers, but if you take the normal basis, which is right here for October, a 450-pound steer typically is about $30 over that feeder futures contract, and a 550 is about $14 over it. So, our 475-pound steer would be, that would work out to a basis of around $26. Add that to $1.62, that would say that the futures market is suggesting that these 475-pound calves are going to be about $1.90. What'd that come out to? $1 or $1.88, I guess it was, $1.89 in October. Now that's probably not also going to happen. That gives us a range. The seasonal price index said about $1.68, and the futures market is saying $1.88. That's a range that even an economist can come up with, but we're probably going to wind up in that low to mid 180s range for those 4-weight calves, which is higher than where we are now. And that's because these markets are trending up. The other thing we can look at here is what do we expect next spring. So if we look at the March contract, 166 right now, or was this morning, on a 750-pound steer coming off of wheat in early March, the basis is about $2 a hundredweight. Let me get to that right here. So let's do a 750-pound steer in March, about $2 a hundredweight. So that would give us a March price of about 168 that you could lock in today. We've been as high, that's what this was for, just about a week and a half ago. We were up around 171 at one point in time and dropped off the end of last week. But it's back to kind of the range we've been in much of the time here in this, 165 to 168 range for much of the last few weeks. So, that's a price that that's being offered by the futures market right now. Let's see, where do I go from here? I have run some preliminary budgets. There's a lot of assumptions, but if you take the idea of $1.83 or something for a 475-pound steer going in this fall, make a bunch of assumptions about gain and cost of wheat pasture and medicine and vet and interest and all of that stuff, I come out, tentatively with a break even that is substantially below what that futures market offer is, somewhere in the range of 150 to 155 for a break even, compared to that market offering us 168 or thereabouts. And that's been the case. I've run several budgets over the last few weeks. It looks to me like there's some opportunity being presented there. Now, all bets are off if you don't actually act on it. So, you have to take a position. You can, sell a futures contract or potentially buy a put or do something to lock in some sort of minimum price on that feeder futures. And take out some of the risk. Obviously, anything can happen between now and then. We've been through lots of black swans and so on. Bottom line is prices are looking better for the rest of this year, for next year, and even for the year after that. Let me jump to this. I think this is my last slide, and then I'll see if you have any questions right quick. So bottom line is, again, we're looking for higher prices based on continuing strong demand in the market and getting some of these, bottlenecks that we've had cleared out of the market, and the fact that cattle numbers are generally getting tighter. We're going to have smaller cattle supplies, and that's going to help support prices. And it's going to, again, as long as these feed prices stay high, there's going to continue to be some stocker opportunities. So I just said that. That's kind of the summary. Markets are generally trending higher. There's a lot of optimism built into that, and the value of gain is an opportunity there. So Brent, I'm going to stop there and see if we have any questions. Let me stop my share.
Excellent. And I've allowed people to unmute themselves to ask over microphone, or people can ask questions through the chat box as well. Either option is possible.
Okay. Okay.
Brian Frecking.
Yeah, Brian.
The steers versus the heifer chart that you showed looked like it was about a 20 cent gap between the two. It seems like,
as far as the basis.
Yeah, but
Yeah.
So prices seem to be a little bit wider on that gap at the auction market. Can you say one way or another on anything on the heifer versus steer deal?
Well, to be honest with you, I haven't looked at it carefully, Brian. You know, I'm not sure that I have a good explanation for that right now. Some of that may be seasonal. You can't see this, and that's okay, but let's see, where's my other, oops, no, that's not what I want. That steer to heifer discount does have a seasonality to it. And so, although it's generally reflected in these basis numbers that I presented, so I'm trying to think through whether there's any, maybe it's just the fact that we are somewhat in a liquidation phase. The heifers probably aren't getting any help at all from a breeding standpoint. So maybe they're a little weaker compared to, a normal situation. Any other questions? I'm not hearing any, Brent.
Well, I also have shared a link to a webinar survey in the chat box. We would ask everyone to fill that out for us. It's helpful to get your feedback and see how we're doing and find ways that we can improve our webinar series for you guys.
Yeah, thanks for getting that, Brent. I forgot to put it in my PowerPoint.
Sure thing. Yeah, that happens. So I've started sharing that through the chat box to make it as easy as possible for people to click on and fill that out for us. So we welcome your questions. And like I said, you can ask them either through the chat box or unmute yourself. So if there are no other questions, we will wind down today's webinar. I would like to thank everyone for joining us, and we will see you next time. So thank you and have a great day, everyone.